All right, welcome Facebook people. We'll let people get started. Glad you're here.
Welcome to overseeing the equity awards offered by your company.
Yeah, absolutely. Sometimes known as stock awards. Sometimes people talk about different terminology, but at the end of the day, it means that your company is giving you a piece of the company. You gain to participate in company profits and success, hopefully, right? Hopefully that happens. But today we're going to unpack that and dig into the details. So we'll give people one more minute to get signed into Facebook or to Zoom or however you're finding us today.
Absolutely. And we do welcome any and all questions. So if you happen to be live with us online today, please feel free to ask questions in the Q&A box located at the bottom of your screen.
Absolutely.
Good. Yeah, this definitely seems to be a pretty popular one that we talk about with a lot of clients, I think.
Yeah. A lot of our clients that are still working, I'd say the majority of our clients work for a big Fortune 500 company. They're getting some different benefits from their company, and especially higher up on the food chain that you find yourself at that company. In a lot of roles, people do get stock options or stock awards, things that maybe not everybody get. So that's why this is particularly important, because it can be a bit confusing if it's something you haven't had before.
And they can be a pretty big boon to your retirement scenario.
Yeah.
Honestly, depending on how they go. And so they definitely have tax impacts that will uncover for you as well. A lot of things to consider.
Yep, absolutely. All right. Looks like we're at 11:30 and ready to go.
Very good.
All right. Sounds good. Welcome everybody to the Keystone Financial Studios. Got myself, Josh Nelson, and Jeremy Busch. We are wealth advisors, certified financial planners, financial advisors. We get called lots of different things, but more or less, we are here to be your financial experts, your trusted advisors. And today, the topic that we're hitting is overseeing the equity awards, sometimes known as stock awards, offered by your company. So it probably means that you work for a fairly large publicly traded company, and there's some type of a plan that they're offering you, and there's variations of that. So we're going to talk about the different things that you might find yourself getting, or you might get in the future. It may not be something now, but maybe you get a promotion.
Yeah.
Maybe you pop up a level into a VP role or manager role or something, and now you're starting to get those awards. Can be pretty substantial.
Absolutely.
Yeah.
And like we were saying, that can be a pretty big part of your retirement when it really comes down to it. So how do you end up managing that and managing it wisely?
Yeah, definitely. So we're going to dig into that today. We are recording this as well, just so you know. So if you're here live, that's great. Then you can ask questions and see all kinds of stuff, maybe the behind the scenes stuff, right? But also you can pass this link on afterwards. It'll be available on our YouTube channel. And for those of you who are listening on the Wiser Financial Advisor podcast, of course, you can pass the podcast on as well. So lots of ways to share this, lots of ways to go back and listen to this again or view this again. So glad you're here. Today, we are going to be talking about equity awards, and the reality is they can be very rewarding, sometimes not if your company doesn't do well, right? So there is risk. Clearly, there's going to be risk involved. And so everything we talk about today, as always, is going to be just our opinions, our experience, things that as financial planners we deal with pretty much every day. We've got lots of clients that end up with equity awards and need to manage those. Absolutely. So this is something that we are very well versed in. So equity awards can be rewarding. They are a significant way for companies to incent their employees, and especially, again, if the company stock does do well, it can be very rewarding. In fact, many of our clients in their careers actually made way more money by the equity awards that they received than what they ever got in compensation from their salary and bonuses. So it can be substantial, especially if the company does well. So certainly a wealth creation tool for the employee. From the company's standpoint, it can be good too, because you're giving your employees skin in the game. Really, in a lot of companies, if they're huge companies with tens of thousands or hundreds of thousands of employees, it's a way that the employees can participate in the company's success. Also gives exposure to the stock market, because we are talking about ultimately a stock of some sort, something that's going to react with the stock market. So it does give exposure to the stock market and the company's sector. So there are some rewards that come with it, but there can also be some challenges.
Absolutely challenges. So just like, you were saying, part of the stock market, you have that economic risk. That's part of that, the ups and downs. I think more than not, these types of things get called the golden handcuffs, right? Because depending on the timing of vesting, you know, you can be getting
Absolutely.
close to retirement and say, well, I really just want to hang on for that next vesting of these. Or
Yeah,
how much money am I going to leave on the table if I leave now versus if I wait for 6 more months or another year,
Right.
right? But I think the biggest challenge is the not wanting to sell, the fear of missing out. You know, either I don't want to pay the taxes, or I'm sure that the stock is going to be higher, you know, in the future,
Yeah.
or whatnot.
Yeah, that's where it can get alluring too. If the company's stock has been doing well and continues to do well and continues to do well, sometimes we get lulled into thinking if something's going in a particular direction, that it's going to continue going in that direction forever.
Absolutely.
Yeah.
Recency bias.
Yes.
Yep. And so it's a lot of the time, and we see this all the time, I think, with people who have enormous equity awards, is that those positions build up and they become such a big part of your portfolio that it can actually be detrimental to your portfolio if something happens to that.
Sure
company.
can. Yeah, absolutely. So a lot of individual company risk there
Mhm.
and market risk, right? I mean, you could be working for the best company in the world. And
Yeah.
if the stock market crashes, your company stock's probably going down too.
Absolutely.
Yeah.
Yeah.
And we don't want to keep all your eggs in one basket. Again, stocks could go to the moon or they can go the opposite direction. There are lots of examples of that. Over my career, I've been doing this since 1999, and it was kind of an interesting time because that was kind of the end of the bubble, right? Of the stock market bubble, the tech bubble, the dot-com bubble. And of course, lots of dot-com stocks that don't exist anymore. Many of those companies were never profitable. So, you know, some of it may be obvious that some of that stuff went out. But you look at the companies that we have on the screen here: Enron, WorldCom, Sears, Roebuck, Eastman, Kodak. And for our younger clients, they're like, who are these people, right?
Yeah.
We don't even know, right? They've been broke,
Absolutely.
they've gone broke for a while, but these companies all used to be at the absolute top of their game.
Yep.
I mean, the world, some of the biggest companies, most successful, profitable companies in the world.
You
Lehman
could
Brothers in the financial
You
crisis,
could
right?
add GE to this list.
Yeah, GE.
You know,
which,
companies big, so big that
yeah,
at one point people said, no way,
Right.
they're way too big. Nothing's good, bad's gonna happen.
right. Yeah, or use an example, we didn't put it on the list, but General Motors. So we think about General Motors, and again, for those of you who have maybe entered the market more recently, you might not know that back in the financial crisis in the 2000s, General Motors actually went bankrupt. United Airlines, early 2000s, went bankrupt.
Right.
Now, do those brands still exist? Do the companies still exist? Yes, they actually do. But if you had been a stockholder of one of those companies, you would have ended up losing every penny. You would have gone to zero
Rough.
as far as value. So sometimes it's not even that a brand disappears completely. It could be that we're looking at a situation where they go bankrupt, they go through some struggles, they reorganize, but you still end up with nothing. Toys R Us, that's kind of sad. Again, it's reemerging as a brand, right? And Macy's, I think
Right.
they have a
I
little.
think it is.
Yeah. So and Blockbuster Video, of course. So,
I actually found an old Blockbuster card in an old wallet of mine
Did
the
you
other
really?
day.
Oh, wow. Yeah. Yep. So Blockbuster Video famously had the opportunity, I think it was for $50 million, something like that. They could have bought Netflix because Netflix was nearly broke back in the early days. They needed some capital. They met with the Blockbuster folks, and Blockbuster laughed them out of the room, and it wasn't that much longer, and
They got the last laugh.
Netflix sure did. Yeah, so no one stays on top forever. Even if you work for the best company in the world, realize that it's not going to last forever. It could be for a long time, right? Companies can be successful for decades and have a lot of profitability, but ultimately won't last forever. And you don't want to get stuck holding the bag when things are going well.
Absolutely. Yeah, and so then of course just the cycle of market emotions. So and this really plays in kind of like we were talking before, right? Is I got all these awards and it's been doing really well, and I don't want to miss out if it goes better or when it goes down. Oh, you know what? It's going to go back up. I'm sure it's going to go back up.
Yeah,
and it really is just a roller coaster of emotions. And so that, I think, is probably the hardest thing for people to do on their own. Is kind of be objective about the emotions of all of this, you know, pulling the excitement out of the reality of it,
right.
When it really comes down to it, and
Or
knowing
the fear on the downside, right? Especially when you're looking at maximum pessimism, right? When you're talking about the bottom of the financial crisis or the bottom of the dot-com crash or 9/11, times when the market went down a lot very, very quickly. Think about the pandemic, the stock market dropped about 30% within a very short amount of time, within weeks, right?
Oh, yeah.
Of the
Very
pandemic
quick.
hitting. So yeah, it certainly can happen. And the cycle of market emotions, basically, the tough part about it is that the cycle of market emotions always makes you want to buy more, makes you want to take on more risk when prices are high, right? Because
Mhm.
again, that recency bias of thinking, yeah, the stock market's going up, it's going to continue to go up forever. And the same thing on the downside when things are looking terrible, when there's blood in the streets, some of those metaphors, right, are kind of gruesome, but the reality is when it's so bad, that's usually the best opportunity to buy, but nobody wants to at that point. It doesn't feel good,
Absolutely.
right? So having that discipline, having somebody that's not you, right? And as a fiduciary, we have to give you advice that's in your best interest. Really, we're here to look out for you and help you make those decisions. So you're not just stuck in your own head and you're not stuck making those decisions at those critical times.
Absolutely.
So let's talk about stock awards.
Yeah, so RSUs or restricted stock units, I would say these are probably the most prevalent that are out there. And
Right now
probably
they
for a
are.
good reason.
Yeah.
Yeah. We see these the most mainly because this is how companies can really get a buy-in
Mhm.
because they can give you the awards, but then these vest over a specific amount of time. So it's not that they're giving out the stock and then the next day you can turn around and sell it, right?
Right.
It has
Yeah.
vesting periods.
Golden
that,
handcuffs.
Absolutely. This
Yeah.
is the golden handcuff situation
Yeah.
here.
Yeah.
Right. So
So meaning that, it's tough to leave, right?
Yeah.
To jump across the street to a competitor when, well, yeah, but I've got all this kind of money sitting there if I stay.
yeah, because no matter when you leave, you are ultimately leaving money on the table.
Right.
It's
Yeah.
just a matter of how much and when.
Yeah. With most companies, and there are some, I'd say it's more the exception, but there are some that if you reach a retirement a retirement kind of milestone or something like that,
Mhm.
that they'll actually let you vest them at retirement, but that's not common. Usually, if you leave, money's gone at that point, whatever you haven't already received and has become unrestricted.
Yeah, absolutely. So there are some specific things around that, but
Mhm.
really the keys to these are, grant date, when the shares were granted, vesting period. And when we say vesting period, that can be anywhere from quarterly to annually to really, they can pick,
Sure.
right?
Yeah.
I think
It's up to your company.
it really is. It's up to the company. I think most of the time what we see is either quarterly or annually.
Mhm.
And so if they give you, say, 1,000 shares, maybe they say quarterly vesting, that means pretty much evenly every quarter you get 250 shares.
Yeah, I'm seeing quarterly. It seems like a lot of the
Yeah.
companies that our employees or our clients work for, not our employees, but that they have that quarterly, which
Mhm.
is that much more enticing, right?
Yeah, because
As
then I
far
only
as
have you for 3 more months.
3 more
for
months,
that
I can
next
do
one.
3
I
more
can do
months,
3
right?
more months.
Yeah,
Absolutely.
yeah. We have a lot of clients in that situation, which it's a wonderful problem, but
Mhm.
sometimes people have a hard time retiring, right? Because it's so much money you're leaving on the table.
Yeah.
Well, your company knows that, right?
They've
They
done this on
they know
purpose.
that they're trying to keep people from leaving because especially in today's market too, the unemployment rate, especially among engineers, professionals, people that are highly skilled, unemployment rate is very low and it's hard to get employees to switch companies.
Absolutely.
Yeah.
Yep. So then the important thing to remember on these is that they are taxed typically when they become unrestricted or
Mhm.
when they vest,
Yeah.
basically. And so now not always, but most of the time, what happens is the company will actually withhold a few shares
Mhm.
to pay the tax. That when it vests, they withhold a couple of shares, they pay the tax for you.
Right.
It shows up on your W-2, and now all of a sudden you have these shares. Right now, not all the time. I've run across a company or two who did not do the withholding shares, and then you were stuck with the tax at the end of the
Yeah.
year. So it's just very important to know what your company's policy is on this and
Mhm.
how that works.
Yeah, usually you can tell from your pay stub. That's the best
Yeah.
evidence. We'll ask if clients are asking us. In other words, we'll say, well, give us your pay stub. Let's take a look at it and see
Mhm.
what's happening. We'll usually be able to decipher that. Biggest thing here is making sure that you don't have a big tax surprise. Nobody likes that, right? To get to tax time and, oh, wow, all of a sudden I owe thousands or tens of thousands of dollars that I didn't expect. That's not great. So we
Yes.
do a lot of tax planning with our clients, especially as you get into higher income brackets, more complexity in your situation. We end up doing a lot of tax planning with people to kind of help them know what to expect.
Yeah, and RSUs can really swing your taxes one way or another.
Yeah, they sure can. And this is a good problem, right? This is it's
Yeah,
a
it's
wonderful
definitely a
problem.
first world
Yeah.
problem. Yeah.
But yeah, I definitely don't want to leave money on the table either. And oftentimes when people maybe haven't optimized their planning, let's just say that if they haven't optimized their planning and they're kind of winging it, it could be that you're paying unnecessary taxes or having unnecessary stress, if nothing else, of just not
yeah.
knowing how things are working.
Yep, just the not knowing. So
So to use an example, walk us
yeah.
through one.
So if for an example, I think we just kind of talked about this. So if we said, hey, I got a share on January 1, I got basically a grant is what it's called,
Mhm.
right? And then they say, hey, we're going to do a 4-year vesting schedule. So that means every year for 4 years, you get 250 shares that vest or they become yours on that date, basically on that January 1 date.
Right.
Right. So again, that can be quarterly, that can be annually. In this example, it's annually. And so really what we have on any kind of equity is 3 main dates, right? It's the grant date,
Mhm.
is the vesting date, and then it's the sale date. And so with RSUs, really that vesting date is kind of the important one because that is when those shares become yours.
Right.
Right. And then when those shares become yours, they typically do withhold a few shares to pay your taxes. But then all of a sudden, now you have, shares that are out there, they're live,
Mhm.
and they're yours to do with what you want to do with them.
Yeah.
And the key then at that point is you have some options. So if it vests and you say, I'm immediately going to sell this, no further tax consequences, really.
Correct.
Right. If you say nope, and I would say a lot of people are in this boat and they say, no, I'm going to hang on to these shares. The company's doing really well.
Mhm.
And so they'll hang on to those shares. And then really it becomes a matter of capital gains at that point.
Right.
And so people come to us all the time with shares that they've been hanging on to for years.
Yeah.
And,
Which sometimes works out great.
a lot of times it works out great
Yeah.
for them, but maybe they have some really big capital gains. But
Mhm.
anytime capital gains enter the situation, you really have to look at the short term versus the long term. Of course, anything that's short term, and short term, we mean basically 366 days or less.
Mhm.
If you sell it from the date of that vesting, that's going to be a short term capital gain that's taxed at basically your highest tax rate,
Right.
whatever that
Yeah,
might
your
be.
ordinary income bracket. Yeah.
Yep. If it's 366 plus 1 days, your long term, which for most people is typically at that flat 15%.
Mhm.
Highest rate is 20%.
Yep.
On capital gains right now.
Yep. Absolutely. Plus state taxes. If
Plus,
you,
yeah.
depending on what state you live in, you may have state
always
tax,
got to get that part.
sometimes even city taxes, depending on where you live.
Yeah.
So the key is the taxes here. Really, when the grant date hits, you're not taxed at all, right?
Correct.
There's no tax consequences
Not
up
with
front.
RSUs.
It's at the vesting date. And so for that reason, though, a lot of our clients, what they do, because especially if they're aggressively getting additional RSUs, they could find themselves in a situation where they have an awful lot of their net worth that's exposed to one company. So oftentimes what we'll recommend, and people will do pretty readily actually, is that the second that those shares become unrestricted, they'll sell them right away, because really there's no tax advantage of hanging on to them at that point. You've already paid the taxes at that point. So then it's really just a matter of, do we see upside? Maybe there's upside, but of course, if you've got, say, a quarterly vesting schedule, the stock that you still have, right? That's going to be unrestricted here in a few months. You still hold that. You're still going to be taking advantage. So oftentimes it does kind of take the emotion out of it if you kind of sell as it vests, simply because then you can take it, diversify it, pay off debt, whatever you need to do in your own financial situation, takes that money off the table.
Absolutely. And a lot of the times, people that do come to us don't do that, or never did, because they always thought, hey, this has nothing but upside.
Right.
And so then it's a matter of, well, this is such a big chunk of your portfolio, it's almost unhealthy.
Yeah.
Right. And so then it comes down to us saying, well, we need to come out with some kind of schedule, some kind of way to peel this off in a tax efficient manner, because maybe you do have a ton of capital gains in there. And so it's really about tax management at that point.
Yeah, absolutely. So yeah, again, good problems. So
Good problems.
yeah, but make sure you understand the rules. A lot of times people end up making mistakes or have unexpected surprises just because they didn't understand the rules or how things work.
Absolutely.
So let's talk about something that's a little bit less common now. But for sure, most companies are using RSUs, so that's why we spend so much time there.
Absolutely. So then the non-qualified stock options. So these are probably the more simple of them. There's no real vesting date. You did get basically you get some options, and it's that, right? It's an option to buy. You don't have to buy
Right.
if you don't want to. And we'll talk about, underwater stock options here later
Right.
on. But that's literally what it
It's a
is. It's
fun term.
hey, you have an option to buy this. Usually there is a discount associated with it.
Mhm.
So you can buy the shares for cheaper. Typically it's an exercise and sell immediately. You don't have to sell, but again, all of those three dates and three prices are really in play here, right?
Right.
The grant, the exercise, and the sell.
Yeah, and that's kind of key again, the golden handcuffs element of this, in that most of the time, if somebody leaves their company, their stock options are worthless at that point. They're not
Mhm.
exercisable. Again, depending on your circumstances, you may have a certain period of time, or maybe at retirement, they would give you a certain period of time. But there's particular risk here because with stock awards, when you receive the shares of stock, you could actually hang on to those. So if it happened to be in a bear market or something like that, you could just kind of
Mhm.
wait, right? And hope they come back up with stock options, because there is that expiration date, and we'll walk through one here.
Yep.
That's a big risk, right? You run up against that expiration date, and your company's stock happens to be down. I had that happen a lot over the years with people, is that, well, waiting. I don't want to pay the taxes, all these things,
Yeah.
right? And then they waited until the last month before the expiration. Stock was way down, and then they were either worthless or worth a lot less than they would have had before.
Absolutely.
Yeah.
So it's tough playing that waiting game.
Yeah.
But the one thing that kind of makes non-qualified stock options different. So we still have the grant price and date, we have the exercise date, and we have the sale date. Now, what happens here is when these get exercised, there's the difference, or basically the dollar cost of the difference between the grant price and the exercise price. And so these are usually the exercise prices at a discount. When you exercise the option and you say, yes, I'm going to buy these options, right? I'm going to fulfill them. There's that bargain element, or that discount price, basically. When you exercise that, that is immediately considered ordinary income to you,
Right.
whatever that benefit is, whatever that discount is. And then after that, again, kind of going back to what we said before, it becomes a capital gains thing.
Yeah.
So you can immediately sell right then and there. And if you've had that discount, then automatically those shares are worth more than you bought them for.
Yeah.
So that's basically the name of the game, right? But then if you do choose to hold them, again, you're still going to be subject to short-term
You're
capital
still
gains
taxed.
if under a year, long-term if over. So it's just a matter of timing really on that.
Right. So that's one thing that RSUs and non-qualified stock options have in common, is that they're both taxed as ordinary income, kind of when it becomes available, essentially when the exercise happens. And that's called a cashless exercise. I think that's the most common on a non-qualified stock option. When somebody decides, hey, you know what, I'm just going to buy and sell right away. I really don't want to hold the stock. And usually employers, or whoever they're using, Fidelity or Schwab or something like that, to administer their stock plan, usually they'll have that lined up. So you're not actually having to send money in to buy the stock. If you tell them you want to do a cashless exercise, it's instantaneous.
Absolutely. Yep. The lesser known, but they do still exist, is the incentive stock options.
Yes.
So these are by far the most complicated of all of the equity awards.
Right.
Just because there are some serious tax tax implications on this. Now, ISOs, like we said, these are very, very rare. Typically what you see with these are brand new companies that are up and coming. They want to incentivize their employees to hang around, have some ownership in the company, and push the company forward. But maybe they don't have the ability or the cash flow to give you RSUs or non-qualified stock options. Right. So there can be some tax advantages to these. But again, it comes down to timing. So and the other important part of this is alternative minimum tax implications as well. So these can get very, very complicated very, very quickly, but we'll try to give you a quick overview of these. Honestly, I will tell you right now, anybody that does have incentive stock options, you probably already know it. And if you need help with them, talk to somebody like us, because it's going to take somebody like us to actually give you the dollars and the numbers
Yeah.
associated with what this actually means for you
Yeah,
guys.
every situation is different on all of
Absolutely.
these. So yeah, none of these are recommendations, by the way.
Yeah,
If you're our client, if you're our client, you're paying us, then we can actually recommend, give you advice, but this is all
absolutely.
general information.
Absolutely.
Yeah.
So just to kind of give you some basics on these, really, it's time is an essential part of incentive stock options. So ISOs. The bargain element, of course, we have the same three pieces. We have that grant date, the exercise date, and the sale date. Now, the important thing to remember with these is that bargain element, or the difference between the grant and the exercise date and the prices involved with each, that is subject to alternative minimum tax when they get exercised. Now, the idea is, in order to take full tax advantage of an ISO, you have to have the exercise date is 1 year from the grant date, and then the sale date is 2 years from the grant date, or an additional year past that exercise.
Yeah, so there's some critical timeframes here, but it
Absolutely.
involves buying the stock. The other ones we were talking about, try to get rid of it, sell it, right? In this case, there would be a tax advantage potentially, right, to actually buying the
And
stock and holding.
Absolutely. Yep. So there's things like alternative minimum tax that gets involved in that first year. If you end up not meeting both of those timelines, it's not one or the other. You have to meet both of those timelines. If you end up not meeting both of those timelines, that's called a disqualifying event. Basically everything gets counted as ordinary income tax.
And just screwed up
someplace.
someplace.
Yeah, right. You're basically paying more
and they will
taxes
catch
than you
that.
needed to.
They will catch that. Yeah.
Yep.
Yeah.
The IRS is really good at catching that one.
Yeah.
So, but basically it's the difference between that bargain element, or the grant and the exercise difference, being counted as ordinary income versus all of it getting counted as capital gains.
Right. So it can be substantial, because
Absolutely.
especially if you're in a high tax bracket, you could be paying like half potentially, right, of what you would with ordinary income.
Absolutely. Yeah. And so you can literally just look at this and see all the math involved.
Yeah.
Right?
If you're just listening to this, by the way, we do have these slides available on our YouTube channel later on today as well. So if you're just listening to this and you want to walk through these examples, we'd always be happy to do a screen share with you as well. But I'm going to kind of fly through a couple of these just because they are less common and they are very individualized based off of each person. We don't see these as much anymore. If you do have them, again, you probably know it. And it's worth really unpacking it, because there's a lot of places you can screw it up.
There really is. And it's just the difference between, having to pay more tax versus not having to pay more tax just by waiting a specific time frame. So it's really easy to screw up, but it's if you're aware of what you're needing to do, it's a lot easier to do the right thing.
Yep, absolutely. And then one that's pretty darn common, I know a lot of publicly traded companies will offer what's called a stock purchase plan or stock ownership plan. So you'll probably be aware of that in your benefits package if it's available. But it can be nice because it does give you the ability to buy into the stock. So it's not being given to you like with the options and the RSUs. So with the stock purchase plan, it means that you can buy it. And not always at a discount. Sometimes it's just, no, we just let you buy it. It's just a convenient way to have it taken out of your paycheck. But more often than not, we'll see anywhere between a 5 to 15% discount that your company will give you on the stock price. So it can be substantial, right? Unless the stock goes down, right? And then, well, it didn't mean anything. But if the stock even just breaks even or goes up slightly from what you bought it at, if you're able to buy at that discount, it could actually be a substantial amount of money.
Absolutely.
Yeah.
Yeah, and that is this next to the RSUs. I would say this one's probably the next most popular, next biggest one that we do see. But like you're saying, it's literally just you sign up for it. I think most companies do this quarterly, and then once a quarter, they take some money out of your paycheck and give you a couple shares.
Right. Yep. So can be nice from a tax standpoint. This does get treated as capital gains, but there's a little bit different timing issue here, right? With that bargain element, we call it the bargain element, is that discount, essentially the part that your company was giving you as far as a benefit.
Yeah. And so again, that bargain element is dependent upon that discount. If your company does not offer that, then the bargain element is basically zero, right? So you're just buying it at that. But if it's anywhere of that 5 to 15% that we typically see, that gets counted in there. Of course, the income at the time of purchase, basically. So The bargain element doesn't get recognized when you exercise that or when that actually happens.
Mhm.
So it turns into shares on the exercise date. And then you hang on to those shares. Again, you have the option if you can sell them right away
Mhm.
and just say, hey, I'm going to take this. And then basically when that happens, you can do your capital gains. Again, it's kind of an immediate thing. It's an immediate ownership. So it's basically like buying the shares on the exercise date.
Right.
If you were to turn around and sell them immediately, really basically that's a short-term capital gain.
Yeah. So to
Um,
use an example, yeah, maybe
Yeah.
of a hypothetical stock that's trading at $10 a share.
Absolutely.
Yeah.
So we'll just say fair market value is $10 a share. You get a 10% discount. That means you're buying it at $9 a share.
They
So
gave you a buck.
they gave
Yeah.
you a buck.
Yeah.
So you get $1 of bargain element. You don't get taxed on that when you initially buy these shares.
Mhm.
So that just kind of hangs out. It's on the books for a while. If the sale happens, now typically these are 2 years after grant or 1 year after purchase.
Both of those
Um,
things have to happen.
Yep.
Yeah.
They kind of like the ISOs in that manner, is
Mhm.
that you have the timeframes involved with this.
Yeah.
But if you follow the timeframes, you typically get the long-term capital gain part of this. So there is some benefit to holding on to stock purchase plan shares to meet these timeframes. Again, if you don't meet those timeframes, you have the disqualifying event. So basically, if it happens before 2 years of grant or 1 year from purchase, everything gets counted as ordinary income.
Yeah.
It's just typically a higher rate.
It can be a big deal. The highest federal rate right now is 37%. Excuse me. And the highest capital gains rate is 20%. So it can be a big difference if
Yeah.
you're in a high bracket.
Absolutely.
Mhm.
And honestly, I think a lot of people that do, not all, but a lot of people who are involved in a stock purchase plan are probably already up there as far as earned income
Yeah,
each year.
yeah, absolutely. Yeah, that's one distinction too, is that with most companies, everybody can participate in the stock purchase plan
Mhm.
versus some of the other things we've been talking about. If you're listening to this presentation and you're like, RSUs options, what are you guys talking about? I've never been offered that. That's because not everybody usually gets that.
Yeah.
That's usually at certain levels of the company, certain positions, so the company can discriminate. Versus the 401k, there's certain things, right, that everybody gets to participate in. These are kind
Yeah.
of special benefits that, again, if you have them, it's a great problem, but it's something that you may not have faced before. Maybe you started at a lower level position within the company and now
Mhm.
you've got these in your lap.
But it's definitely something you want to be aware of how they work and make sure that you're doing the right thing.
Yeah. So, and this could fit into if we did a series called Financial Planning Horror Stories. This underwater stock options. We'll talk about what that means. Underwater stock options, which
Yep.
I think these days, especially as technology's gotten better, the companies like Fidelity and whoever's administering these plans, they've gotten better at not letting you screw up. But this is an example of how you could screw up stock options exercises.
Absolutely. Yeah. So again, it's an option, right? And so you
Mhm.
have the option of buying. You don't have to, obviously, but you do have the option of buying the stock. Now, what makes an underwater stock option underwater, as the saying goes, is that the exercise price of the option. So the exercise price is what they say, hey, this is an option to buy this stock at this price.
Mhm.
But if the exercise price is higher than what you can buy that stock for on the open market, it's called underwater. So basically you'd be paying $10 for a stock that's worth $5.
Right. Which makes
Which
no
doesn't make
sense, of
sense.
course. Yeah.
Right? If you're
Yeah.
gonna go, if you're gonna buy it, you might as well just go to the open market and buy it for $5 if you really want the stock that bad.
Yep.
Right.
Early in my career, I saw it happen.
Yeah.
I actually saw it happen with somebody and we weren't helping them. They probably wouldn't have done it if they were talking to
Right.
us, but they just
Yeah.
felt so bad that their stock options they were up against their expiration date. And they're like, well, I got to exercise, I got to do something. These things are going to expire worthless. So they exercised.
Ouch.
And again, back then, maybe the technology wasn't as good. And so they actually were allowed to do that. They were allowed to buy the stock
Ouch.
at a higher price. Yeah, than what they would have gotten it on the open market. So
That hurts.
kind of ugly.
Yeah.
Yeah. If your options are worthless, if they're underwater and they're coming up against their expiration date, I'm sorry to inform you, they're just going to expire worthless. They're going to expire
Mhm.
underwater, but that's a lot better than exercising underwater options.
Yeah,
Yeah.
and basically losing money on it.
Yeah.
So the important thing to realize is that too, like you may be saying, well, I can just do a tax loss on this if I'm looking for a tax loss. Well,
It still doesn't help.
the
Yes.
exercise itself does not actually qualify as a tax loss.
Right.
So you would literally have to buy the shares at the higher than the price, sell the share. It gets really messy, really quick.
Yeah.
So
Yeah.
it's
You don't want to do it.
just not worth it.
Yeah. But
Right.
yeah, sometime we'll do a webinar called Financial Planning Horror Stories.
That
And
would be awesome.
we'll think of like
Sure
our
will.
worst ones that we've seen throughout our careers.
Absolutely.
All right. Diversification. So here's why this is so important, because you look at the chart here, the Callan chart. This was actually put together by our friends over at the Callan Institute. But what they do is that they take all the major asset classes year by year. It's a nice colorful chart, but it shows you what did the best, what did the worst. And last year, 2022, cash actually did the best. In other words, not investing in any place,
Right.
even though interest rates were near zero at that point. At least you didn't lose money. Every other asset class went down last year. Very different from this year so far, at
Oh,
least.
absolutely.
Knock on wood, pretty much everything is up this year, but not everything is going up and down equally. So the diversification benefit of spreading your money out instead of just having it one sector or one stock is really, really important.
Yeah, and the interesting thing is, and this is the prime reason why we diversify, right? Is
yeah.
because no one can tell you which one of these asset classes is going to be at the top or the bottom next year.
Yeah.
It just it's how the chips fall. So that's why we own a little bit of everything, so we can smooth out that ride.
Yeah, and it's just human nature, again, that recency bias of thinking that
Mhm.
something's been happening, especially if it's been going for a long time too, right? Maybe it's a particular
Oh, yeah.
sector like tech stocks or something like that. And people can get lulled into thinking, well, tech stocks have been the best performing sector and they're always going to be the best performing sector. And that's just not true.
Mhm.
Last year, actually, energy was the best sector in the S&P 500. This year, not as much. So it's definitely more tech. Should you own one or the other? Yes, both, right? To diversify.
Right.
You want to make sure
Absolutely.
you've got exposure to all these areas. So it's important to make sure that your portfolio, you know how it's invested and where the risk is and what you're comfortable with. That brings us to asset allocation, which is our fancy way of saying don't put all your eggs in one basket, and making sure that wherever you're investing your money, it's at a speed limit that's appropriate for you and what you can actually tolerate.
Absolutely.
So risk when it comes to investing really is like turbulence, right?
Absolutely. It's just volatility. It's how much ups and downs you can go through. And some people like looking at this stuff every day, and they might get a little jumpy every, because it does swing by the hundreds of points, right?
Yeah.
Or it can from day to day, and it'll drive you nuts. But the important part is finding that asset allocation that again, you can live with. It might get uncomfortable from time to time, but if you have that long-term vision and that long-term plan that says, this is where we're going and we're going to get there over a long enough time period, we can take the rest of it, and that's good.
Yeah. So that's when we exercise the options in the stock and all this stuff, that's the common question is, well, what do I do with it now? And that's really the answer is it depends.
Absolutely.
Depends on you, depends on your time frame, depends on what you're comfortable with.
Absolutely.
Yeah. Some people just don't get on airplanes because they know turbulence scares them, drives them nuts. And we know airplanes don't crash because of turbulence. So just really uncomfortable
Get
sometimes.
very
And
uncomfortable.
so it's important to understand kind of what you can tolerate, so you're not faced with pulling money out when things are way down. And we give some examples here. Again, if you go to our YouTube channel, you'll see some of these on the replay. But average rate of return on different types of portfolios, conservative could be about 5%, aggressive could be about 10%. It's a big difference. But excuse me, the worst 12-month return on a conservative portfolio down 17 versus down 60 on an aggressive portfolio. So a bad year can be really bad when it comes to an aggressive portfolio. Now, it should be said, I think, not that we can guarantee anything, but it should be said that for somebody that put money into an aggressive portfolio during a really bad year like 2008 or 2020, had they hung on, as long as they were diversified, they would have gotten their money back, right? Or most of it would have come back. And in the long run, we'll go over decades. Even the worst market downturns don't last forever.
Absolutely. But sometimes it does take time. So if you're looking at a period between 2008 and how long that took to come back versus 2020
Quite a
or
few
even
years.
2022, you know, how quickly those bounce
Yeah,
back.
2020
So,
was months, right? I mean, and people were kind of
months.
back up, versus years after 2008.
Absolutely.
Yeah. Or the year 2000, right? Dot-com crash,
Oh,
2001, 9/11, 2002, Enron, WorldCom went broke, bunch of stuff, right?
Absolutely.
After year, basically it took you a better part of a decade. It actually took you about up to the financial crisis
I think so.
to get your money back, and then boom, financial crisis happened. So there was a good span of time there where it would have been very difficult
Yeah.
to be patient and hold on. But then after 2008, we saw the best bull market run ever,
Yeah. For the
best
longest,
economic run ever from 2009 to 2020. So it actually would have paid off for somebody who stayed diversified, rebalanced. They were very disciplined as an investor.
Absolutely.
Yeah. So everybody's different.
Yep.
Yeah. So Tony Robbins says complexity is the enemy of execution. And our friend Sir Richard Branson says complexity is your enemy. Any fool can make something complicated. It is hard to make something simple. And the reality is a lot of this stuff is complicated and we didn't make the rules, right? The tax code, the estate planning code, all the stuff that we have to deal with as far as the complexity of the world. And maybe you think all this stuff that we just talked about is very complex, because it is.
Absolutely.
Right? Yep. But again, we didn't write the tax code. We didn't design your employee benefits, but you are in a position where you've got to make decisions, and you definitely don't want to leave money on the table. You want to make sure that you're taking the best advantage you can and you understand the rules.
Absolutely. So yeah, and it really is. It's whenever we talk about just equity awards in general, those you can see how quickly those can get complicated.
Yeah.
Right. And so I think a lot of people kind of default to that. They might not understand it. And so that complexity overwhelms them a bit. And then it's just, you know what, I'm just gonna hang on
They
to
just
it.
don't do anything. Yeah.
Yeah, I'm not gonna do anything.
Right.
I'm just gonna hang on to it. And that in of itself, you can benefit from that if the company's really strong, but there are some downsides to that as well. And it can be a lot more expensive down the road.
Yeah. Yeah, absolutely. So if you find yourself needing help in any of these areas, and the chart we have up shows all the boxes that we put up here are about investment planning and estate planning and tax planning, all the areas of your financial life. That's what we do is comprehensive financial planning, meaning that we're really looking at everything in your financial life, not just your investments. So it's important to recognize that we're here as a resource. We certainly love working with our clients. You can see our team up here. Our bright shining faces work for you. And this is what we enjoy every day, really, is knowing what's going on in your life, your situation. And it really, as things change over time, that's what's fun for us, is that people's lives change, the economy changes, the market changes, the tax code changes. That's really why so much of this is so complex, is that even if you're able to learn all of it, it changes constantly. So we're in the trenches every day. And excuse me, we get to be in the trenches every day with you.
Absolutely.
Yeah.
Keeps it new, keeps it exciting. Let us worry about it so you don't have to.
Yep, absolutely. So I've got a frog in my throat, but you can tell this is live. We're not editing it, right? We're real people. We're actually real financial advisors. We're not we're not AI robots, right? Not yet anyway. So glad you're here though. Appreciate you. I certainly appreciate you and your families. Anything that we can do to support you. Josh at keystonefinancial.com, Jeremy at keystonefinancial.com, and our website, no surprise, is
keystonefinancial.com.
keystonefinancial.com.
Absolutely.
So love to work with you. If you have any questions, use this as a resource. Otherwise, have a wonderful weekend and God bless.